ceasefire was announced. Markets celebrated. Silver jumped more than 6% in a single day. Gold surged. Oil fell below $100. Relief rallies swept across every asset class on the planet. And then, quietly, the Strait of Hormuz remained closed. Not partially open, not slowly reopening, closed. According to CNN's analysis of shipping data, on the day after the ceasefire, just one oil tanker, a sanctioned vessel, transited the strait. One tanker. In the waterway that normally carries 20% of the world's oil supply every single day. And then, within hours of that first ceasefire day, Iran halted tanker traffic again, because Israel struck Lebanon, because the ceasefire, according to Iran, was already being violated, because the ceasefire, according to NBC News, is fragile in every possible direction. So let me ask you something. If the Strait of Hormuz is still closed, if the ceasefire is so fragile that it nearly collapsed in its first 24 hours, why is the market acting like the problem is solved? And more importantly, for silver investors watching this, what does a fragile, potentially collapsing ceasefire mean for the metal that has been quietly building one of the most powerful structural cases in commodity market history? That is what we are covering today. And what I am about to show you is why the 3-week rally in silver is not the story. The story is what happens next. Stay with me. Let me walk you through exactly what this ceasefire actually is, and more importantly, what it is not. On April 8, 2026, just hours before President Trump's publicly threatened deadline, where he warned that a whole civilization will die tonight if Iran did not reach an agreement, a 2-week ceasefire framework was announced between the United States and Iran, mediated by Pakistan. The ceasefire calls for an immediate halt to hostilities, the reopening of the Strait of Hormuz to commercial shipping, and a 15 to 20-day period of negotiations between Iran and the U.S. On the surface, good news. But here is what every silver investor watching this market needs to understand. The ceasefire was announced at the absolute last minute, under maximum pressure, hours before Trump's explicit threat to restart bombing. According to CNBC analysis, expert Matt Gertkin of BCA Research stated directly, "The sense of urgency appeared to be more pronounced on the U.S. side, not Iran's side. The U.S. side, that is the first red flag. The second red flag happened the same day the ceasefire began. Israel launched what Lebanon's health ministry described as the deadliest strikes on Lebanon since September 2024. According to NBC News, at least 254 people were killed in a single round of Israeli attacks on Lebanon. Iran's response was immediate. Iranian Parliament Speaker Mohammad Bagher Ghalibaf stated publicly that Lebanon and Iran's regional proxies, the entire resistance axis, are an inseparable part of the ceasefire. The United States and Israel said the opposite. Lebanon is not covered. Two sides, same ceasefire. Completely different interpretations. On day one, Iran halted Hormuz tanker traffic within hours. The ceasefire nearly collapsed before it was 24 hours old. And as of today, April 11, 2026, according to NBC News live reporting, Amborchen sur Imsinger, there is, quote, little sign that the crucial Strait of Hormuz trade route has meaningfully reopened. Little sign this is not a ceasefire. This is a pause. A fragile, contested, already violated, barely holding pause between two sides that are talking in Pakistan this weekend with J.D. Vance, Steve Witkoff, and Jared Kushner in negotiations where Iran's parliamentary speaker says time is running out, and the market priced this as if the war was over. Silver jumped 6%. And that 6%, while real, is not the story. The story is that the fundamental problem has not been solved. And when that becomes clear, the next move in silver will make 6% look like a footnote. Here is the single most important thing happening in global markets right now that most people are completely missing. The day after the ceasefire was announced, Iran's Islamic Revolutionary Guard Corps Navy Command posted something extraordinary on X. Their exact words, as reported by NBC News. In these 2 days of the period of silence in military conflict, both the enemy and allies have come to clearly understand through experience that the management of the Strait of Hormuz has entered a new phase. Reread that. The management of the Strait of Hormuz has entered a new phase. Not the closing of the strait, not the war, the management. Iran is announcing publicly that even in a ceasefire environment, even in a peace negotiation environment, they intend to permanently manage the Strait of Hormuz differently than they did before this war began. This is not a temporary wartime posture that evaporates when a peace deal is signed. This is Iran signaling that the strategic leverage they discovered when they closed the strait, the leverage that drove oil to $112, the leverage that paralyzed Western energy markets, the leverage that forced the United States to send J.D. Vance to Pakistan to negotiate under deadline, is leverage they intend to keep. Former Iranian Supreme Leader Khamenei said it explicitly, publicly recorded and reported by NBC News. Iran will certainly bring the management of the Strait of Hormuz into a new phase. This is a permanent shift in the geopolitics of global energy. Before this war, the Strait of Hormuz was an open waterway, a given, a constant. After this war, no matter what the peace deal says, The Strait of Hormuz is a managed resource, managed by Iran, with the demonstrated capability to close it at will. And for silver investors, for every investor watching this, the world that existed before February 28th, 2026 is gone. Let me show you the disconnect that every serious silver investor needs to understand this weekend. When the ceasefire was announced on April 8, markets responded exactly as expected. Silver surged more than 6%, gold jumped 2 to 3%, stocks surged across Asia, Europe, and the US. Oil fell below $100 per barrel for the first time since the conflict began. The relief was real, the rally was real. But here is what Jeff Yu, senior market strategist at BNY, told CNBC's Squawk Box Asia on the day of the ceasefire. What the market is going to start pricing ahead is a first step towards further de-escalation and perhaps something more permanent. Notice what he said. The market is pricing in something more permanent. But the market has no guarantee of something more permanent. The market is betting on an outcome, not responding to one. And Josh Rubin of Thornburg Investments issued an explicit caution. He warned against reading the early market reaction as a definitive verdict. This is the classic relief rally trap in commodity markets. The price reflects hope, not resolution. And according to BCA Research's chief geopolitical strategist Matt Gertken, quoted directly by CNBC, fighting will ignite later this year, if not later this month. Later this month. If the ceasefire collapses, if Israel continues striking Lebanon, if Iran follows through on its threat to leave the ceasefire, we return to a world where the Strait of Hormuz is closed. Oil rockets past $110. Inflation expectations spike again. Fed rate cuts get pushed further out. And silver, which has been building structural supply deficit pressure for 6 years, which is already 40% below its January all-time high, which has record industrial demand from solar, EVs, and now defense, gets another reason to move dramatically higher. The relief rally gave you a preview. The real rally waits for the structural case to reassert itself, and the structural case was never in danger. Let me decode what has actually happened in silver over the last 3 weeks, because the narrative most people have attached to this rally is incomplete. The mainstream read is, ceasefire announced. Oil fell, inflation fears eased, silver rallied. And that is partially correct, but it misses the more important story. The panic low in silver was around $61 per ounce, hit during the most intense phase of the macro override. When the Iran war triggered oil above $112, Treasury yields spiked, and $2 trillion was wiped from precious metals in 3 hours. From that panic low at $61, silver has now recovered to approximately $75 to $76, a 23% recovery from the absolute bottom. 3 consecutive weekly gains. And according to FX Leader's analysis, the technical picture has shifted. The 50-period moving average is turning upward near 73. The RSI, the momentum indicator, is at 66. Strong, not yet overbought. Silver has broken above the 0.5 Fibonacci retracement level at $75.49. The next resistance is $78.85. If silver breaks $78.85, the technical target opens to $83 and beyond. But here's what the chart does not show you. What drove the recovery was not just ceasefire hope. It was the physical market reasserting itself. According to FX Leaders, silver is still trading dramatically higher than its 2025 pre-conflict range of $30 to $50. The supply deficit, now in its 6th consecutive year, did not change during the macro override. The industrial demand, solar, EVs, semiconductors, defense, did not change during the macro override. China's export licensing controls on refined silver, locking up 60 to 70% of global supply, have not changed. What changed was sentiment. And sentiment, as we learned in the March crash, can reverse as quickly as it formed. The question is not whether silver's rally is real. It is real. The question is what fuels the next leg, and whether you understand it before or after it happens. While the market was fixated on the ceasefire drama, while everyone was watching J.D. Vance fly to Pakistan, a data point was published that received almost no attention: the March Consumer Price Index. The first inflation reading since the Iran war began, 3.3%, the highest reading since May 2024, with a monthly jump of 0.9%, the steepest single-month increase since the middle of 2022. And simultaneously, Q4 GDP growth came in at 0.5%, half a percentage point, near complete stall speed for the U.S. economy. High inflation, low growth. Put those two numbers together, and you have the definition of stagflation. Not a theoretical risk, not a forecaster's warning. Actual data, published while the world was celebrating a ceasefire that was already cracking apart. Now, why does this matter for silver? Because stagflation, the combination of rising inflation and stagnating growth, is historically the most powerful macro environment for precious metals, specifically for silver. In the 1970s stagflation era, silver went from approximately $2 per ounce to $50 per ounce, a 2,500% move, over approximately 7 years. We are not predicting that. Nobody should promise that. But the macro environment, the one that drove that historic silver rally 50 years ago, is the macro environment that March CPI and Q4 GDP are describing right now. High inflation, low growth, energy shock, Federal Reserve trapped. Cannot raise rates aggressively because growth is already collapsing. Cannot cut rates because inflation is rising. The Fed is in a corner. And in that corner, how is so... Assets, with structural supply constraints and record industrial demand, have historically performed unlike any other asset class. This CPI number was not a detour from the silver story. It was confirmation that the macro conditions for the next major silver move are already in place. While the market obsesses over whether the ceasefire holds, the structural reality underneath silver ticks forward every single day. Regardless of what happens in Islamabad, regardless of whether J.D. Vance gets a deal done this weekend, regardless of whether the Strait of Hormuz reopens tomorrow, the silver supply deficit continues accumulating. We are now in the 6th consecutive year of global silver demand exceeding mine production. 6 years. Every year, the world consumes more silver than the mines produce. Every year, the gap gets filled by drawing down above-ground reserves, by draining vaults, by pulling metal that was stored in prior years of surplus that ended years ago. According to FX Leader's analysis, JPMorgan expects average silver prices to be around $81 per ounce in 2026 as a full-year average. Average, not peak. The global silver market has experienced supply deficits running into the hundreds of millions of ounces. COMEX registered silver inventories, the physical silver that backs paper futures contracts, are down approximately 70% from their 2020 levels. London Bullion Market Association vaults have lost approximately 40% of their holdings. This drain was happening before the Iran war started. It continued during the Iran war. And it will continue regardless of whether this ceasefire holds or collapses. Because the drain is not driven by geopolitics, it is driven by physics. The world needs silver to build the green economy. The green economy is being built whether or not the Strait of Hormuz is open. Solar installations, EV manufacturing, semiconductor production, AI data center infrastructure, all of it consuming silver every single day against a mine supply that has been structurally constrained for years. The ceasefire is a news story. The supply deficit is a structural reality, and structural realities always win over news stories. Now let me talk about the number that surfaced this week that most analysts are not putting in their headlines. $300 per ounce. Bank of America, Citi, and Reuters have cited $300 as a scenario target in the context of tightening COMEX inventory and accelerating structural deficits. Now, I want to be very clear here. $300 per ounce silver is not a near-term prediction. It is not a promise. It is a scenario analysis. A description of where silver could go if the structural forces currently in motion continue on their trajectory, without the kind of significant supply response that would require years of new mine development. But consider the distance from where we are now. Silver is at approximately $75. JPMorgan expects 81 as a 2026 average. Goldman Sachs projects 85 to 100. Bank of America has a formal target of 135. And the $300 figure represents the upper end of what happens when a structurally constrained physical market finally prices in 6 years of deficits, China's export controls, and record industrial demand all at once. Each of these numbers represents a different scenario, but notice what they all share. Every single one of them, JPMorgan, Goldman, Bank of America, is above the current price of silver, not slightly above, dramatically above. And the institutions publishing these numbers are not fringe analysts. They are the most sophisticated commodity research operations in the world. They have supply chain intelligence. They have industrial demand data. They have government contract flow information. And collectively, they all see silver going significantly higher from where it trades today. The ceasefire is a pause in the geopolitical story. It is not a pause in the structural story. Right now, as you watch this video, negotiations are happening in Islamabad, Pakistan. J.D. Vance, Steve Witkoff, Jared Kushner, facing Iran's parliamentary speaker Ghalibaf, a man who publicly posted this week that time is running out. The U.S. team arrived with a 15-point proposal that includes Iran committing to no nuclear weapons, handing over highly enriched uranium, limits on Iran's defense capabilities, and the permanent reopening of the Strait of Hormuz. Iran's position includes recognition of Iranian sovereignty over the Strait of Hormuz, an end to all Israeli and U.S. attacks on Iran and its allies, war reparations, sanctions relief, international recognition of its right to enrich uranium. These are not two positions that are close to each other. These are not two sides haggling over the margins. These are fundamentally incompatible strategic visions. The United States wants Iran to surrender its nuclear program and give up strategic control of the strait. Iran wants recognition that it controls the strait permanently, and that its nuclear program is a sovereign right. According to Trump himself, speaking at Joint Base Andrews on Friday, the number one U.S. objective is no nuclear weapon. That's 99% of it. And Trump added, if it doesn't resolve quickly, we'll be able to finish it off one way or another. This is not the language of a conflict moving toward permanent peace. This is the language of a pause with a threat attached. And BCA Research's chief geopolitical strategist, Matt Gertken, was direct when he told CNBC, fighting will ignite later this year, if not later this month. For silver investors, this matters because it determines the duration of the relief rally we are currently experiencing. If talks succeed, the macro override eases further, and silver's industrial fundamentals drive a slower, sustained recovery. If talks fail, the macro override returns, oil spikes, markets reprice, and silver faces another volatile period before the structural forces reassert themselves at higher levels. Either way, the direction for silver over the medium term is the same. But the path there is going to be volatile. And understanding why is what keeps you from making the mistakes that cost investors serious money in this environment. Let me give you 5 specific scenarios, mapped to where silver is likely to go. These are not predictions. These are scenario analyses, the same kind of framework used by institutional research desks to manage exposure in uncertain markets. Scenario 1. Islamabad talks succeed. Full peace deal reached. Hormuz reopens completely. Oil falls below $80. Fed cuts rates. In this scenario, the macro override fully lifts. Rate cuts reduce the opportunity cost of holding silver. Dollar weakens. Industrial demand, unaffected throughout, reasserts as the dominant price driver. Silver moves steadily higher. Institutional targets of 81 to 135 become the roadmap. This is the bullish base case. Scenario 2. Talks achieve partial agreement. Hormuz partially reopens. Oil stays elevated between 80 and 90. Fed holds rates but signals future cuts. In this scenario, silver continues its current recovery trajectory. 3-week rally extends. Price range, $75 to $90 over the next several months. Volatile but directionally higher. Scenario 3. Talks fail. Ceasefire collapses. Hostilities resume. Hormuz closes fully again. Oil hits 120 plus. In this scenario, the macro override reasserts short term. Silver sees another volatile correction, but the structural floor, built on 6 years of supply deficit, turn to the panic lows. The eventual recovery from that correction would be sharper and faster than the previous one. Scenario 4, talks produce temporary extension. Another 2-week pause, more talks, more uncertainty. In this scenario, silver trades sideways to slightly higher in a tight range. The macro override neither fully lifts nor fully reasserts. Accumulation environment for investors who understand the structural story. Scenario 5. Stagflation scenario accelerates. March CPI was the leading indicator of a sustained inflation surge. GDP continues declining. Fed trapped, cannot cut. Physical demand intensifies. COMEX vault drain accelerates. In this scenario, silver reprices against the structural reality, independent of the geopolitical outcome. This is the scenario where the higher analyst targets, beyond 135, begin to look credible on a shorter timeline. All 5 scenarios have one thing in common. In all of them, the structural foundation under silver, the 6-year deficit, the China export controls, the industrial demand, the vault drain, does not change. The geopolitics determines the path, the fundamentals determine the destination. Let me bring everything together. A ceasefire was announced on April 8th. Silver jumped 6%. And then, Iran halted Hormuz traffic again. Within hours, the Strait of Hormuz, which normally carries 20% of the world's oil supply daily, has had essentially one tanker pass through since the ceasefire. One sanctioned tanker. Iran's military has publicly declared that the strait has entered a new phase of management. The Islamabad talks this weekend are between two sides with fundamentally incompatible positions on nuclear weapons, on Hormuz sovereignty, on Lebanon, and on the entire scope of what this ceasefire covers. BCA Research's chief strategist says fighting will ignite later this year, if not this month. Meanwhile, March CPI came in at 3.3%, the highest since May 2024, confirming the stagflation thesis that has historically been silver's most powerful macro environment. COMEX vaults are down 70% from 2020. The silver supply deficit is in its 6th consecutive year. China's export controls, locking up 60-70% of global refined supply, have not been modified, and every major institutional bank on Wall Street, JPMorgan, Goldman Sachs, Bank of America, has maintained price targets for silver that are substantially above where it trades right now. The 3-week rally was real, but understand what drove it and what did not change. The relief rally was driven by ceasefire hope. The structural rally was the one that comes next. Will be driven by what always drives commodity prices in the end. Physical reality. The physical reality is that the world needs silver to build the future, and the supply of silver, to meet that need, is structurally constrained in ways that a 2-week ceasefire does not fix. The ceasefire trap, the thing this entire video is about, is the trap of believing that because sentiment improved, because markets rallied, because oil fell below 100. The underlying story changed. It did not. The ceasefire paused the macro override. It did not resolve the structural deficit. It did not reopen the Hormuz permanently. It did not lift China's export controls. It did not rebuild COMEX vaults. It did not reduce solar demand. It did not reduce EV demand. It did not reduce defense demand. The 3-week rally was the market catching its breath. What comes after the ceasefire, whether it holds or collapses, is the real story, and the real story points in one direction. I am not here to promise you silver is going to $100 by the end of this month. Nobody can promise that. What I can tell you, with every piece of data we have reviewed today, is that the forces driving silver higher are more intact today than they were 6 weeks ago. The macro override taught investors a painful lesson about leveraged paper positions and short-term macro chains. The structural reality of silver never changed. And when the market fully understands the difference between those two things, the next move in silver will not look like 6%. The Islamabad talks are happening this weekend. The ceasefire could hold, or it could collapse by next week. Either outcome matters for silver. We are going to track every development. If you want to understand what each outcome means for the silver market, subscribe right now. Because this story does not pause when the weekend starts. The IRGC is posting about new phases of Hormuz management. Iran's parliament speaker is saying time is running out. Trump is threatening to restart bombing if the deal does not hold. This is not a situation that resolves quietly. And every week, we are going to be here, cutting through the noise, going straight to the data, and showing you exactly what it means for your position. Drop your answer in the comments. Does the ceasefire hold? Does the Islamabad deal succeed? Or does fighting resume by the end of April? Tell me what you think. I will see you in the next one.